Welcome back, options traders. Well, another good question for the group. What do you think about perma-puts? Well, I can tell you for sure, perma-puts are a really bad idea, and yet it's something that a lot of traders use. So what are perma-puts, and more importantly, why are they such a bad idea? Let's go find out more about these, and before we do, as always, please be sure to click like and subscribe. It's greatly appreciated and definitely helps to promote the channel. So perma-puts, what are these? Well, they're not really a type of put. You can't go out and buy a perma-put. It's not like an American style put or a European style. Instead, it's just kind of a catchy phrase that traders use to mean permanent insurance. And so the idea of perma-puts is that you are continually buying puts so that you have permanent insurance. It doesn't matter when the market falls, you're always ready to cash in on it and pick up this extra money. You're never going to see your account balances fall because you've got these insurance policies in place. And the idea of this, obviously, is so that you never take a loss. Well, that sounds like a great idea on paper. After all, who wants to take a loss? But once you do a little bit of digging, you'll find out it's a really bad idea. Now, think about, for our first step here, what you're trying to do with permanent insurance. You're saying that I always want to have my portfolio insured forever. Well, what's the problem with that? The problem is that there is a long-term upward bias to the market. And if there's a long-term upward bias, what are you really insuring? In fact, by having this permanent insurance on your portfolio, you miss the opportunity to invest money at lower prices. You're just spending this money on insurance, hoping that you catch a downturn, and then if you do, all you're doing is just basically breaking even. So here's a long-term, or at least fairly long-term, of the S&P 500, going back about 10 years, starting in January of 2014, and you can see, look at that, very distinct long-term upward bias. Here's COVID. So again, even if you held through here, did it really matter? 7-8 months, we were right back at all-time new highs. So does it really matter that you actually rode this dip down here if you came right back? What if you had never watched the news, never looked at your account during this, let's call it an 8-month period here, and never even saw it dip? You'd never even know that it happened. And so from your perspective, you'd say, hey, look, we're at all-time new highs. So what was the purpose of the insurance? See, in that sense, the insurance is just doing no good. So for instance, let's say that we have a stock at 100 and it falls down to 90. Well, yes, that's a $10 drop, but if it comes back $10, who really cares? See, what you could do instead when you're down here is to buy. Remember that the market volatility is what creates the rewards, and this is sometimes part of how you need to capture those rewards. When the market deals you what might be viewed as some bad cards, in other words, that the prices are down, look at it as a good thing. Well, if I'm in it for the long term, let me buy down here. Why not buy some shares and some assets that can appreciate over time forever and ever, instead of buying insurance back here that really has no benefit? Now, yes, it is true that you could make an argument without the insurance that these drops will cut into compounding. We all know that volatility erodes returns. We've talked about that in many past videos. But in order to dodge that, you'd have to be able to predict every twist and turn in the market. But the even bigger problem with permanent insurance is that, like all insurance, it's just designed to make you whole, just to get you back to where you were, not to create profits. Why is that? Well, that's because the market accounts for the probability of volatility, and it does that by accounting for price. So we've talked about this concept in many videos. Remember, price is the equalizer. Price makes the trade fair for the buyer and the seller. And that means that the market price equals the expected value. And so if the price that you're paying for this insurance is what it's expected to be worth, then you're expected to break even in the long run. That's the very definition of fair value. The market is always trying to figure out what these puts are worth, or any option for that matter. So the markets aren't going to sell you an insurance policy that, let's say, pays off $10 half the time for less than $5. It just isn't going to do it. Now, are there little pockets or moments where it might happen? Of course, but it's not going to consistently happen. So to see why, let's build a little model here. So in this model, let's assume that we have a 50% chance for a $100 stock to rise or fall 10 bucks. That's just giving it some form of volatility. Sure, we could make it a lot more complicated and give it a standard deviation and talk about volatility and fair value, and we're going to come up with exactly the same result. It's just going to be harder to understand. So let's make it simple. The stock can rise or fall 10 bucks half of the time. And the question is, what's the $100 put worth? Well, we can figure that out. We're going to say that 50% of the time it'll be worth 10 bucks. If the stock falls from 100 to 90, the put is worth 10. That would be the payoff. You could close that put for 10 bucks. But if it only happens half of the time, we multiply 10 by 50%, that is worth 5 bucks. However, the other half of the time, it's going to pay off nothing. We're going to see that sometimes the stock closes above our $100 strike, in which case we collect nothing. So on average, we're going to just add these up, multiply them together first. We're going to take 5 plus 0, and we find out that the $100 put should be worth 5 bucks. Now, an easier way to see why that's true, let's say that the odds worked out perfectly on our first 2 attempts. So the first time we spend 5 bucks on the put and we gain nothing because the stock price went up. And the second time we buy a put, we spend 5 bucks, but we gain 10. So here it paid off nicely. But if we look at this, we're going to see that we spent $10 to gain 0 plus 10 or 10. So if you spend 10 to gain 10, that's a very clear way to show that you're not going anywhere. Again, this is the very definition of fair value. All right, so if we go back to our diagram here where we said that the stock falls from 100 to 90, it falls 10 bucks. But you spent 10 on average to get that, there's no benefit in it. Again, there might be moments where you profited from it, but in the long run, which is what we're talking about because it's permanent insurance, in the long run, there's absolutely no benefit. So you're just going to end up with no value. However, when the market does rebound, you're not going to be able to capture this. You're also going to miss this. Why? Because you missed the buying opportunity. Instead of spending this money on insurance, you could say, all right, I can't predict when these markets are going to fall, but I can see when they have, and therefore I can, with 100% certainty, take advantage of it. And I could put that money down here and actually buy something that will retain value and grow and compound. Now, again, some people say, well, I'm going to buy the insurance and I'll also buy down here. That misses the point. You cannot spend the same dollar twice. If you want to say that you were going to spend $5 on each put back here, well, then you could have also put that down here. So you always are going to miss putting some money at the lower prices if you are buying insurance, especially full-time on a portfolio. So to get a more detailed look at how this would work, let's go over to an Excel spreadsheet and take a more detailed look at this simple model. Okay, so this Excel spreadsheet is really just a more detailed view of what we just did. And here we're going to call these, let's say they could be years, they could be months, days, it's just some period of time where you're going to be buying this insurance. So we're going to run that for 200 different simulations down here. And then we're going to let Excel flip a coin. Half the time we're going to say that the market is down, half the time we're going to say it's up. Again, this is our volatility. Over here in this column, we're going to say what's the value of the put. So remember, we're going to assume that the stock falls from 100 down to 90, in which case the put is worth 10. Now that doesn't mean it's a $10 profit. We account for that over here. But the put by itself, the payoff is 10. If the market is up like it was on this trial, the put is worthless. All right, now in this column, we're going to say the cost of the put, as we calculated, is 5 bucks. And so if we run a simulation in Excel, we can see that the revenues, in other words, all of the values here, we're just going to sum this entire column up, 1,020. So you brought in 1,020 from your puts, but let's also now account for the costs, 1,005. You can see that, as expected, it should be a wash. Now, it will rarely be an exact wash, but that's just the nature of randomness. On average, it will be. So in this case, we got $15 after 200 trials of puts. After commissions, it's an absolute loser. Now, if I hit F9, we can get another simulation, and here you came up ahead by $25. Revenues of 1,030, costs of 1,005. Let's try it again. Now you lost $5. Try it again. Now you're down 25. And we know that on average, you would be zero here. Now, these two columns are doing exactly that. This is what's called a Monte Carlo simulation. We're going to do it 100 times. So this first trial right here is doing what we just did on the left 100 times to come up with that number right there would be 45. Trial number 2 is another sequence of 100 tries. We came up plus $125 that time. Row number 3 is another trial of 100 tries. We came up with minus 25 that time. So now it's just a lot faster than having to hit F9 over and over and over 100 times. Let's just take the average of this column. And there it is. So you're down $6.1 after all that work. Think of how much work that is. Again, not counting commissions. Let's do it again. You're up $1.20. We'll do it again. Down $8.70. You can see it's just spinning your wheels. There's just no money in it. Now, there's a whole nother argument that we haven't covered. We're assuming that the puts are priced fairly. And as with all insurance, nobody is going to sell you a put option, collect a fixed premium, let's say $5, but assume all of the downside risk, especially once the markets have started falling. So you're not going to be able to find something that truly has a value of 5 for exactly 5. This is what we call a skew in the market. Maybe the market prices it at $5.50. So let's put $5.50 here, and now look what happens. Watch this over here. You're always going to be negative. Look at that. And this isn't even counting commissions. It's just accounting for the skew. Look at this. You will never see this go positive. Now, that doesn't mean it's grossly negative. It just means, like I said, you're just spinning your wheels. Now, what we're not accounting for here is all of the money that you could have put into the market at these drops, and then fast forward, let's say, another 5 or 10 years into the future and say, what would we look like then with all of this compounding? But right now, I'm just trying to show why permanent insurance is a really bad idea. All right, and that raises a good point. Is it ever a good idea? Well, sure, you can always make some arguments. For instance, maybe you're on margin and you can't afford to get a margin call over a short period of time. Let's say over the next 30 or 60 days, or maybe even the next week. Maybe there's an upcoming earnings or an FDA announcement. You've got some type of a biotech stock, and they're coming out with a phase 3 clinical trial announcement, and you are just going to be devastated if you have to fork over more money for a margin call, especially if this stock falls 20 or 30%. So you might say, all right, in those cases, let me get the insurance. So the idea is that if there are moments in time where you feel the insurance is necessary, yes, you could make an argument that buying puts would be a way to hedge that risk. However, this hinges on one important idea, and that is implied volatility. And the only way that that strategy will work is if your assessment of implied volatility is consistently better than the market's. And that's a really big doubt. In fact, if there's anything you're going to bet on, it's better to bet that you won't consistently beat the market's best guess. Save your money on the Perma-Puts, put it in when the market gives you the opportunity to buy at lower prices. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.